Hi, Denise, Naylor here. One of the key questions that I always enjoy discussing with my students is, what do you understand by the term asset? If you start to answer that question yourself now, you might find yourself thinking of buildings, machinery, or perhaps vehicles, know-how, cash, and similar suggestions from a wide range of physical or non-physical objects. Investopedia defines asset as a resource with economic value that an individual owns or controls with the expectation that it will provide future benefit. For me, the key part of this definition is with the expectation that it will provide future benefit. Notice that an asset is not defined in physical terms. It's defined by expectation. It's your expectation, your mindset, that determines whether or not something is an asset for you. What do I mean? In my videos, you've been learning that by increasing your liquidity, you can start to build your cash pile. And you see, it's your cash pile that you use to create assets. Assets that will provide you with future benefit. But your success depends on what you expect. Let's look a bit more closely. To create an asset, you open a savings account, put money into it, and don't take it out until you find a suitable cash generating investment. For all the time that you have cash in your savings account, your bank will pay you interest on the money. That interest is your future benefit from your savings account. When you don't take your money out, your savings account has become an asset for you. But would you agree with me that if you do take your money out of your savings account, you won't receive the interest? You won't receive that potential future benefit. Perhaps you know someone who starts a savings plan and then a few weeks or months later, when you meet them, they tell you, "Oh, I took my cash out. I wanted a nice holiday this year." Or, "I needed to get the car fixed." So what does this mean for you? Your savings account might or might not be an asset. If you open it with the expectation that you're going to dip into it and take cash out whenever you feel like it, your savings account is not an asset. But if you expect to keep your money in that account and not take it out until you find a suitable income generating investment, your savings account is an asset to you. Your property might or might not be an asset. If you live in it and pay all the expenses out of your own salary, your property is not an asset to you. But if you expect to rent your property out and cover all your expenses from rents collected, your property is an asset for you. Your vehicle might or might not be an asset. If you use it only for your own pleasure and ease, your vehicle is not an asset to you. But if you expect it to be used in your business, for example, then your vehicle can become an asset to you. Can you begin to grasp what I mean? It's not the type of object that determines whether or not it's an asset for you. It's how you expect to use that object. Creating assets starts in the mind, not in your bank account. Of course, from time to time, your plans will change and you may not be able to carry out your plans exactly as you expected to do so. But if you have the expectation of creating an asset when you begin to build your cash pile, then over time, you'll start to see objects in terms of whether or not they do provide you with future benefit. Join the Cash Genie Global experience and learn how to create assets for your future benefit. Thanks for being on this call. It's not the object you choose, but what you expect for its use. What you spend cash to get must create an asset. Do join me next week.